Hello, everyone. It's Henry Katarna again. This is the CAST workshop on Are You Investment Ready? And today we're going to do segments number 5 and number 6 of the 6th segment module. So just as a quick update on the last 4 hours that we've spent already, today we'll complete 2 hours, making a total of 6 hours. We've spent the first hour on the process of negotiating capital. Secondly, we talked about the growth cycle of the business. And then in our second session last week, we talked in the first hour on deal structure. And then we talked about valuation. And so today in the third session, we're going to be spending an hour on the topic of the profile, the mindset, and the kinds of investors that are out there. And then finally, we'll end up in the last hour with a range of other topics, such as how to do the due diligence process, how to manage the deal room, the term sheet, non-disclosure agreements, NDAs, preparing the investor package, and also some valuable slide decks that I recommend that you have on offer. So we'll get started. If you have any questions, please let me know by raising hand, or I've set the audio so that you should be able to speak with me directly. So here we are with Are You Investment Ready? Segment number 5. This is about the profile and the mindset of the investors. This is an important part of the process of being investment ready, because it's important that you put yourself into the mind of the investor, how they think, what they're concerned about when they do business with you, and how do they understand the finer points of your business, and how do you build confidence in working with them. So we're going to talk a little bit about that. And so let me begin by jumping into the very first topic, which is angel investors. Angel investors are named because it's like money from heaven. You know, it's a kind of an interesting name that has been developed for angel investors. And partly the sort of the technical business reason why we call them angel investors is because they do come in kind of like as a support to you. They come in very early in the process, right after the founders put money in. So an angel investor comes in immediately and takes the highest risk, more risky than anybody else, really. And they're willing to put their money in, and they're willing to help you, the entrepreneur, for a couple of reasons. One is they likely have been an entrepreneur themselves. And so because they've been an entrepreneur themselves, they know what you're going through. They understand your mindset, your thought process. They understand everything that you have accomplished to date, the challenges you have, the troubles you face, and the excitement and the belief that you have in the value of your product or your service. And so they get that. Secondly, because they've made money already in something else, whether it's another kind of industry or in their own startup, they probably have had mentors as well. And so as a result of having those mentors in the past, they understand the value of being a mentor to somebody. So they support the entrepreneurial spirit. They help you to achieve your goals and dreams, but they understand where you have been. That's the beautiful and the cool thing about angel investors. They understand what you have gone through, and they've been there themselves. And so when they write a check to you, they're going to be somebody that supports you, believes in you, and understands in you. That's the affinity that you're going to find with angel investors. And so I hope you can really appreciate what an angel investor can bring to you. Now, you still have to be as cautious and as wise as possible in dealing with them, of course. But the good news is that they're going to be more predisposed to working with you because they have knowledge of business themselves, and they've probably been through the startup troubles and the challenges and the excitement and the positive features of startups, just like you have. So we're going to talk a little bit more about various kinds of angel investors. And I maybe mention a few of them right now. We have a couple of concepts here with angel investors. Some of them are novices at the game. One of the challenges you face is to find the expert angel investors. And it's not bad to have the novices with you, but you have to be cautious that you're not finding an investor who really doesn't understand the investment process themselves. And so there are angels that are new to the game and they're trying to learn about being an angel investor. So it is good for you to find an angel investor group. And a group can be a gathering of people from different industries or different backgrounds, different ages, and they will come together on a regular basis, usually, to hear pitches. And so if you have the privilege of pitching in front of an angel group, it's good. It's positive. It's an efficient process. You will have, 20, 10, 15, 30 people in the room. And so you can make your pitch once, and then you will see rapidly whether anybody wants that second meeting with you. And if they want that second meeting with you, then you've accomplished something important. And you've done it rather efficiently. You've done it in one meeting rather than having 25 or 30 separate individual meetings. Which brings me then to a point about the angel investment process. It is, for the CEO of the business, a very big preoccupation. When you're raising capital, you need to spend at least half of your time, honestly, in raising capital, discussing with angel investment your situation, going through the process and learning about their needs and kind of convincing them that you have the necessity of, or the value that you can add to them. Sometimes an angel group will charge a company to pitch. And so you should expect that. That's part of the process these days. There's a certain amount of work involved because they do some deal screening. They pre-screen your deal. They may assess you according to a point system. They may assess you according to some criteria that the group has. And so you'll need to spend the time in the process. They may even have staff. They may even have professional staff that work with you to, review your deal, understand it, ask you more detailed questions than the investors themselves want to do. They often don't want to do the prep that you want, that you need. And the prep sometimes is it's a bit tedious, but so you should expect in general that the angel group process now is something that will cost you money. There are some very large groups, Keiretsu forums, for example. You could be charged a couple of $1,000s to pitch to a group. Keiretsu Forum is a very respected group, for example. They have about 50 shops across really North America and in Europe, and I believe in the Middle East as well. And so they will charge you money, but they are professional angel investors in the sense that the groups have an expectation that they're going to write checks that could equal to a certain dollar figure every year. So they're seriously vetted and curated themselves, just as they're trying to do with you. And so it's in your best interest to decide whether you want to do this in a linear fashion by talking to investors one by one, randomly, that you pick, versus going to established groups that have maybe a price tag involved and a particular process, but an efficiency that you would gain by sort of being with them and working on a basis of close-knit relationship, a defined process, and resulting in some clear process, let's put it that way, where you will actually result in a decision quickly. And by the way, your decision that you're seeking is not necessarily to have capital, it's to get the next meeting. So we have in the angel investment space a group called family offices. What is a family office? Well, it's a group of people usually related. So it could be a family group, it could be founders and successors, parents and children, or brothers and sisters, or a loose affiliation of people that gravitate around a particular family. They're definitely going to have professional staff. And so it's very wise of you to look for family offices. particularly if they have an interest in investing in your niche. If you are a certain kind of technology, if you're in property tech, for example, or you're in medical, there are some family offices that specialize in these fields, and so you will be quite professionally handled, really, when you go to a family office that specializes in an area that you're involved in, that your company is pushing forward on. A family office will be, in some ways, old money. It will be a group of people that have a lot of experience, and at the same time, they're going to be helping you to achieve your goals and dreams because their interests are aligned with yours. And because they're a family office, they tend to have an affinity for each other and they'll work closely together. So they understand the power of multiplying several smaller investments, putting them into your deal, and helping you to achieve your goals and dreams. The typical family office is also rather expert at monitoring your progress. So they will work closely with you. They will help you to achieve milestones. If you put out a set of milestones, let's say 5 or 6 different milestones, they will match dollar for dollar in those milestones. Usually they won't give you the whole check in advance, of course, but they will tend to work with you on a progressive basis so that as you achieve a particular set of goals, then they will advance the next round of funds. So they're every bit as sharp as every other investor, but they tend to be a bit warmer, I would say, in how they deal with you. Consortia style investors, on the other hand, are not as known to each other. So they won't be a family group, but they might be a group of professionals that come together, put their dollars into a pool, but then focus on a particular kind of investment. And so they may look at software deals, they may look at efficiency in the oil patch, for example, or they may look at a medical deal, or they may look at a certain kind of manufacturing process. And a consortia style investment group is a little bit more rigorous in the sense of they're strangers to each other in some ways, but at the same time, they want to push you to achieve your goals and dreams and their goals and dreams just as quickly. There are people called super angels. That's another category of people. And these are interesting individuals because they tend to have, they tend to be quite high profile people. They can be quite famous. They can be, in some cases, surrounded by a group of gatekeepers and a group of staff. And if they're surrounded by a group of staff and gatekeepers, you're going to be treated professionally, no doubt, but you're going to be run through a mill, as I call it, of a process that's going to be rather focused, and it's going to be rather technical, and you'll need to know what you're talking about very well. The super angel also attracts around them other more, let's call them regular angels. Super angels sometimes are the leader of a deal. If you can convince a super angel to invest in your deal, there will be others that will follow along with them. And these followers are also good investors, but they tend to look for the signals from the super angel. And so a super angel, on the other hand, is very attractive, and therefore there's going to be a lot of people chasing them. And so your problem, your challenge will be to gain access to them somehow by moving to the top of the heap quickly. And that's a problem. That's a challenge because you're not only trying to convince them of the merits of your deal, but you're also trying to go through their process of screening. They will have a large funnel and it'll sharply narrow quickly to the limited number of deals that they want to see pitched. But all in all, that's good. That's good competition for you. If you have a high quality proposition, well, the super angel is going to be your best bet, obviously. And second of all, you're going to enjoy the process of competing with other deals that will try to seek their capital as well. There are other kinds of funds. We'll spend a minute talking about other funds. There are other kinds of funds that are specialists. For example, there is a group in California that is, it's the in-house capital pool of a large American family that is famous in the construction business. And they have made millions of dollars, perhaps even a trillion or $2 in construction over the last 50 to 100 years. So one of those big organizations that has survived and grown for a long, long time. So they have created a capital pool, and their interest in this case that I'm thinking about, prop tech, property tech. So they are interested in bricks and mortar kind of deals that have to do with construction, construction project management, software related to that, virtual reality, other management tools that help in the construction and the investment in the construction industry process. So that's a real specialty group, and it's a special focus. Once again, if you find the right focus group for your particular kind of company, you're going to find that they're going to move rather quickly. I know of people in Calgary and in Vancouver who have raised money from this particular group rather quickly, literally within weeks. You go there, you pitch, you talk to them, and then they make decisions and they move quickly. And they move on a kind of a formulaic basis. It's not that they sprinkle money without thinking. They do think a lot, but they tend to understand something that could be to your advantage, which is that they might sprinkle money to 5 or 6 or 10 or 20 different deals at a given period of time to see which one thrives and which ones, fall by the wayside. And then they reinvest their funds in that smaller group. So you have that sort of accelerative effect of they put money into, say, 10 deals, and they'll observe the top 2 or 3, and then they will finance those top 2 or 3, and they may not support the other ones at all, or they may support them in a lesser way. So once again, what you're seeing here is you need to learn and understand how these angel groups operate. So a specialty focus fund like that needs some care and attention because your chance is limited, but at the same time, you've zeroed in through all that noise in the marketplace and you have found the right group. And so there's a trade-off there. But the good news is that you will have a positive relationship with them. They're very professional. They will work with you on a quick basis, and they'll keep you posted rather on a timely basis. They're going to let you know right away whether you're in or you're not. And that's a good thing because you need to know that quickly. The danger of many other angels, particularly those who are new to the game, is that they don't know how to say no to you. There's a phenomenon out there that we see quite a bit where they will be speaking with you on a long-term basis, but they will not actually tell you that they're out of the game. And that's a problem because you don't need to be strung along in a linear fashion when you could be working in parallel with 5 or 6 angel groups or angel investors to get the right capital from your pool of money that is following you. So that's a little bit about angel investors. The philosophy of the angel investors in all of these groups that I mentioned is that they care about the entrepreneurial spirit. They do have that feeling. They're not aggressive in the way that venture capital is, and I'll speak about VCs in a few moments here. But the angels tend to be people who understand the entrepreneurial game. They respect the entrepreneurial spirit, and they have different levels of experience and background themselves, and they have different focuses, and they have different kind of styles of doing things. But the main thing is you need to have a good pitch. You need to have knowledge about what you're doing. You need to have an excellent team, and you need to know what your plan is for commercializing and exiting, because that's what they're interested in doing. Same as we said a few sessions ago, the typical angel investor wants to make 5 to 10 times their money back in 2 to 3 years because of the number of companies they invest in, the number of deals that inevitably will fail, and why then they should be concerned about that. They need to have you join with them in this sort of rapid progress. So let's see now. Let's talk about the difference among 3 different types of groups: accelerators, incubators, and colliders. These are terms you're familiar with. The incubator, that's the oldest form of organization that helps startups and early stage companies. The incubator is considered a place where you go, you sign up for a set of services. You might have a co-working space, you might have mentors, you might have coaching, you might have individual detailed assistance in a certain form of consulting, or you might have advice from a panel or a group of people. But the point of an incubator is that it incubates, it starts a little company, it helps you take your startup from idea to commercialization. It does it at a certain pace, and it does it in a way that helps you to achieve growth and traction in the marketplace, but not at a rapid pace. The more rapid pace comes from joining an accelerator, where you might be part of a process that is time limited. For example, an accelerator might say, we have a 3-month process. You join us and you work through a 3-month process where we intensively help you do a product roadmap, the business plan, the market plan, assess your competition, do all the things really that we speak about in our 12 key question format, which is another module that CAST offers. And I urge you to consider signing up for that one. That takes place next week, actually. And the concept there is how to build a great pitch deck, 12 key questions in a 10-minute presentation. Very, very essential and fundamental to your success as an entrepreneur. But the accelerator, just getting back to the accelerator, they will rapidly work their way through a process with you. The good news about that is that within a number of weeks, 3 weeks, 10 weeks, 3 months, whatever it is, you're going to know all that you need to know from them, and they're going to know all they need to know from you. So there's an efficiency to this process that's good. They will understand what you have to offer, and they will see whether they believe that you have, the kind of deal, the kind of product or service that's going to be a disruptor and move into the marketplace rather quickly. The accelerator also tends to operate on a focus not only on time, but on a focus in industry. So you tend to join an accelerator with like companies. And so they might be, let's say you're a software in oil and gas efficiency, production efficiency. You might find that you're part of an accelerator process with 10 of them. Why? Well, so that you can be observed. If there are 10 companies in an accelerator process and you're one of them, and you're all sort of more or less working in a similar field, they're going to definitely check you out. They're going to run you through the process together, and then they will be looking for success factors that distinguish you from the rest of them. And that's the challenge you're going to face, is that you're going to be set up in direct competition, mirroring 9 or 10 other deals, and you're going to all be under serious scrutiny. But once again, that's good. My opinion is that this is good for you, because you will want to, surpass the others. You will want to attract the attention of that capital. The good thing about accelerators is generally they have a pool of funds available, or they have referrals. If they're purely an accelerator but not a fund, they may refer you to funds that follow them. So that's interesting for you. The concept of collider is fairly esoteric. It's not really well known as a topic, but it is out there. And the collider is perhaps even more intensively working with you than the accelerator. What a collider does is that the collider will definitely put you into a process. They will put you into under scrutiny. They'll look at you, they'll examine you, they'll work with you to see, how quickly you can gain traction in the marketplace. But the collider will tend to, for perhaps just like the molecule collider concept, they may take the best elements. In the end, they may make a proposal to you, take the best element that you offer, combine it with the best element that somebody else has to offer, and yet maybe a third company. And so they may pick and choose selectively the top 3 qualities from 2 or 3 companies, and then put you together into either a new entity or some kind of a consortium that goes to the marketplace and more rapidly, achieves traction and starts to get into sales, and then ultimately profitability, and ultimately after that an exit. So that's an interesting line to pursue. It's not well known. All in all, the summary I would offer here is that your due diligence is as important as their due diligence. All these other angel investor groups are interested in checking you out, but you need to be quite forceful with, or at least sharp in your analysis of what criteria do you want? Who do you want? How quickly do you want to achieve growth? What is the specialty that you want to bring? What advice and what input do you want? And are you prepared to work according to somebody else's process? That's the role of the angel investor. Your role is to, once you have accepted the concept of other people's money, taking somebody else's dollars, you're on a path to exit, as you know, and you must do that on a very concerted basis with serious due diligence, spending the bulk of your time attracting the investment and working with them to build confidence and to keep them working with you on a milestone-based basis so that you might get second and third rounds of financing from them. I'd like to turn to another feature of investment in your early stage or startup company, and that is investment that is RSP eligible. Sometimes it's wise to attract a type of investment that is RSP eligible. The reason for that is that you might attract a wider group of individuals. Typically, they are smaller investors, but it's sort of like crowdfunding in the sense that you will attract money from a group of people that are focused on investment in general, not necessarily, they may be generalists, I guess is my point. They're not people that are looking for a particular investment in a particular sector, but they want to support you because they believe in the entrepreneurial spirit as well. They may have some experience themselves, but they definitely want in their own portfolio to be RSP eligible so that they can get the tax credit, or that the growth in their RSP stays with them and actually is very successful for their own private investment. Which then brings me to the point about the portfolio of the typical angel investor. An angel investor, just like you or I, will have a portfolio in mind. They will want to have certain percentage of their investments in safe and secure government-backed, for example, investments. They may invest in their own home mortgage. They may invest in the stock market in blue chip stocks that are very regular in their dividend offerings, for example, or that have a steady growth in revenues and are in a field of I guess that are very successful. And so they will want to put some high risk money, the angel investor money, into deals, but from maybe only a small percentage of their portfolio. And sometimes they even want to secure that by being, registered retirement savings plans eligible. So think about that as an option. It requires some good tax advice, but it's not a bad way to consider. I found that in medical deals, for example, people are interested in putting money into various medical products, medical processes, and as a result of their interest in these things, they may want to put a small set of dollars in, a small dollar figure, but they'll want it to be RSP eligible. And so you might attract, for example, a group of doctors. Doctors are quite famous in the medical and health field for investing in deals. They don't have the time necessarily to focus like an accelerator or a family office would, but they will put money in, particularly if it's RSP eligible, and they might be a supporter of yours. If you have a technology like that, you should be looking at the industry association that is most commonly associated with that technology. So medical doctors, for example, and dentists are often known to be interested in investing in technologies that are in their field. And so that's pretty cool, actually. And it's very interesting. There are other types of investors that behave in ways that resemble that of banks. So far, what I've been talking about is angel investors who will give you money in the form of equity.
They will take equity in your deal, or possibly they will issue a debenture, which is a way of lending you money. We've spoken about that in the previous session. If you borrow money from people under a convertible debenture basis, where you agree to pay them interest, and you will pay interest over a number of years, and then ultimately you'll convert that lending, that debt, into shares, into equity. But there are investors. There's a famous guy in Calgary that's fairly well known. He would be a billionaire and an oil patch guy. And he creates a line of credit funding basis. So he resembles that of a bank. You're going to, if you agree with his approach and he likes your deal, he'll set up a line of credit so that you can draw down funds as you need it through various milestones. He understands your milestone-based approach. He does not sit on your board, but he takes an observer status. So he becomes an observer of your company, and he works kind of looking over your shoulder and setting up this line of credit thing. And so he really wants to make his interest on that. Later, he might consider investing or turning that investment into equity. But at the beginning, the process is a line of credit approach. And so that's a specialty type of investor. And once again, if you can find somebody like that, that's greatly advantageous for you, because you're going to be able to then draw down funds as you need it, like a bank, but he's not as aggressive as a bank. He's going to be an angel investor. And so can you imagine the possibilities there? Factoring is another type of investment, usually associated with companies that are more mature, that already have sales, but that may have challenges collecting. So the accounts receivable problem, particularly in these days, with the pandemic and all of that, big problem. And so factoring comes in as a form of financing. It's not really, I would not recommend it. And in fact, they won't even look at you probably if you're an early stage or a startup company. But you should keep in mind that factoring can help you out on sort of an emergency basis if you have cash flow troubles because of collection problems. When you have revenue, the factoring people come in, they will lend you money against your receivables. They'll give you, I'm making this just a general calculation now, 75, maybe 80% of your receivables, they will finance you. Of course, you're going to pay interest, and you're going to pay interest at a high rate, but it could get you over a hump. If you are having a collection problem with a particular sector or a special time of the year, you will find that the factoring people will come in there, will give you money, and they will create a system where you will get money against your receivables. Once you collect those, of course, you have to pay that back, and the interest cost can be high. But the point is, it can be seasonally something that you do on an occasional basis, or it can get you over a particular hump, like a delay in an approval, for example, FDA approval or something like that. So I don't definitely recommend factoring, but it's always an option. It's definitely out there as an option. Take a minute to talk about crowdfunding. Quite a popular idea, something that's come about in the last 5 to 10 years. And there are many crowdfunding operations. There's one that's quite well known in Western Canada called Front Funder, and I have seen some of their deals. What is crowdfunding? Well, it's a way of getting smaller investors to pool their money according to somebody's professional process. So in the Front Funder example, they will create a process around you. If they agree to take your deal on, you'll pay, of course, some kind of fee, but they will give you mentoring. They will put you into a development process. They will conduct due diligence on you of the kind that the investor would do. They will create a pitch deck for you, and they will give you an opportunity to pitch. And then they will publicize your deal to their audience, which is made up of investors. And when they publicize that deal, they'll open a round at a certain period of time. They might allow it to run 2 to 3 weeks. And they'll kind of, I don't want to say hype or promote your deal. It's not that at all. But they will make it known. They will publicize it to their audience and make it known and understandable to a group of people. And once they do that, you could be the recipient of investment. So it's a pretty sharp model in the sense that it's smoothly running. It's a known process. It's a model that is very well respected out there because it's professional due diligence, and it's a good round of investors that they bring to the table. So if you're an entrepreneur in a startup early stage company, that's one of the key things to look for, is to look for a process where you're put in front of investors who are trained or, you know, briefed on a regular basis and receive industry information, and that where the company, the presenting company, yourself, for example, is also trained in how to pitch properly. The efficiency of the marketplace then, where you have good, well-qualified, well-prepped investors and good, well-qualified, well-prepped entrepreneurs coming together in a marketplace according to somebody's process, like a front funder. It's a variation of crowdfunding, and it's a more sophisticated approach. Crowdfunding has really developed over the last number of years into a very, very positive model, and it's really become much more sophisticated than it used to be in its early onset. I'd like to move now to the topic of how to think like an investor. We've said that a 12 key question format that I have often fostered is a good way to unveil what goes on in the mind of an investor in the logical order of how the mind works. And so the 12 key questions are going to be a way of understanding how the investor checks off the boxes in their mind as they hear your pitch. And once they check off those 12 boxes in the right sequence, which is how their mind works, it's okay, if you can tell me who you are and what you're doing, I'll see if I'm interested. You can tell me what business problem you're solving. Well, then maybe I'm interested. You can tell me what your solution is. Maybe I'm interested. If you can tell me what your technology is, well, maybe I'm even more interested. And so on, all the way down through the 12 steps, the 12 questions in 10 minutes. Because if a person sees 200 to 300 deals a year, they don't have a lot of time to spend on long, lengthy discussions at the beginning. So the wisdom of your 12 key question format and the ability for you to think like an investor and unveil your information in the way that their mind works, this is the proper approach to thinking like an investor. Basically, what you need to do is you need to overcome the skepticism of an investor. The investor is skeptical because they've seen a lot of deals, and honestly, again, no criticism of the entrepreneur. I love the entrepreneurial spirit, and so do all the angel investors. But most deals fail. Most deals fail. And so when that happens, you have the challenge of convincing them that you know what you're talking about. And as we mentioned a couple of sessions ago, the business plan is important, but the business plan is going to go out the window in a few months, generally, because the market will change, the situation will change. Look what happened in the last year. A pandemic appeared and completely disrupted the economic system. And so any expectations that you might have had in March of 2020 compared to, let's say, March of 2021, very, very different. So the ability to think like an investor in the logical way that their mind works is one thing, but so too is the seasonality, the factors that influence an investor's mind. One very tiny example. In the investment world of angel investing, there will be, people will see your deal at any time of the year. There's no doubt. You could pitch deals at any time of the year. But if you start to pitch, let's say after December 15th, you're not going to get any interest. People shut down for Christmas and for other vacation periods, and then they don't come back to work really as an investor till about the middle of January. This is a North American phenomenon. I can't speak about Europe and other Asia, but I can tell you that in North America, if you try to pitch a deal after about the middle of December, you will get nowhere until the middle of January. So you lose about a month there because of that phenomenon. Similarly, in the summertime, if you try to pitch a deal in, I don't know, middle of July to the middle of August, you're not going to get anywhere because people just, they're in vacation mode. They may not be on vacation, but the whole world seems to be on vacation. And so there's this malaise that hits the investment community. And so my point is, thinking like an investor means thinking about when they want to see deals, learning about that and understanding that, thinking about how they check off the boxes in their mind, and then how do they make decisions. And remember that an investor generally works on the basis of incrementalism, one tiny step at a time. They're not going to write you a check after seeing your brilliant pitch. And I hope you can have a brilliant pitch, and I really admire that you will do that. But the investor's not going to write you a check. They're going to, however, want the next meeting with you and the subsequent meeting. And so it requires a huge amount of patience on your part. But at the same time, you can't have endless patience, because you can't be wasting your time going down the path with investors that are never going to go anywhere. So the balancing act, the delicate balancing act you have as an entrepreneur, is to work patiently with the investor, unfolding all the information openly as they need and require, communicating wisely with them, keeping them posted on all the good news and the bad news and all that sort of stuff. But at the same time, understanding that they may string you along, because sometimes they don't want to say no to you. They want to keep hearing what you have to offer. They don't want to say no to you. It's a balancing act. And so I'd like to cover for the next few minutes then how to communicate rationally without overselling. Patience, we've established. You need to have patience, but you need to have resolution as well. You need to resolve rather quickly whether they're going to invest with you or not. And so I have several suggestions for you. This would be 2 or 3 points. One is frequency of communication. It would be wise of you to start kind of a bulletin or a regular publication. I'm not calling it a blog necessarily, but some sort of a report or an update that goes out on a regular basis, probably every month, maybe in the early stages of your investment search, maybe weekly. But this is a communication that will go to all those who sign up for you, with you, on a willingness to hear your story. Keep it short, keep it to half a page or 1 page maximum, bullet points, and real traction, not just activities that seem to show interest in the marketplace, but real traction. If you're able to do that, you can delicately move an investor who you believe is not going to invest with you, but cannot say no to you, onto your bulletin process that goes out. So they will keep in touch with you. You'll be fulfilling your commitment and promise to them to stay in touch with them, but at the same time, you're not going to waste a lot of time with them. But it does require your focus on writing that report, or if it's a video report, recording it, broadcasting it, putting it in a place where they can take a look at it. Short, something like a 1 page where the reading time is 3 or 4 minutes, that's acceptable. A short video, 2-3 minutes, not 20, not 30. Focusing on the things that an investor really wants to talk about. And so when I say communicate rationally, I'm talking about always focusing first on the business proposition. Where are we going with revenue? Are we profitable? Are we going to make money? Are we now selling our product or our service? Are we moving into the marketplace? Is there customer acceptability of our product or our service? That's the main thing. Yes, the technology is important. Yes, the team is very important. Yes, a lot of other things about your marketing are very important. But the key message for the mind of the investor, and this is where I say communicate rationally. The communicating rationally with the investor means talk about how you're making money for the investor. That's what will spark their interest. Everything else is important too. Don't oversell. Over pitching, over promoting can be spotted in an instant. Sometimes entrepreneurs don't even realize they're doing it. And so one of the ways to do this is to have a personal advisory board or a small group of people that you trust, who can hear your pitch, who can read your communications, your bulletins that go out, and who can help objectively say to you, oversell, don't oversell, you're overselling, or pretty good, not bad, showing confidence, showing the positive side of things. Yes, absolutely, we should all do that, but don't oversell. And so there's a delicate balancing act. And sometimes in our zeal as entrepreneurs, we don't know what the line is. And so sometimes we need somebody else looking over our shoulder. And usually it can be a other group of investors that who could be helping you to understand and to be a little bit more disciplined in how you speak, what do you say, and whether you're overselling or not. So that's communicating rationally. A little bit of a bulletin approach, audio or video or written. It's all fantastic. It's all great. Frequency, not too much, not too little. Balanced, fairly objective. Don't hide flaws or problems. You don't necessarily have to draw big attention to them, but be effectively rational in what you say to the investor. They will respect you for that, and you can keep a lot of people in the discussion for a number of months without spending too much time in person dealing with them. Finally, in this segment, I'd like to speak for a couple of minutes about positioning your deal. That's a little different than the communications matter that we just talked about. Positioning your deal. Where are you in time? Are you concept? Do you have a prototype? Do you have a working prototype? Have you beta tested it? Is it already in sales? So where are you in time? Where are you in scope? Are you launching in a very tiny local market? Are you in a regional market? Are you in a national market? Are you already in an international market? Also, positioning your deal in terms of the maturity of the industry or the segment. Are you a disruptor? Is it a completely brand new segment that nobody understands yet, or the marketplace hasn't even really realized is in place? Or is it a crowded space, very well known, with all kinds of competitors, all competing to try to have slight little differentials in product or feature that will attract attention? Position yourself well, and then once you do that, understand who your competitors are in that same spot. This will assist you greatly in, I think, accelerating your pace and also figuring out what are you going to do about your competitors, because there's always somebody working in their basement who's going to catch up to you if you don't keep moving at a certain pace. And this is the ultimate challenge that you have. So this segment, then, segment number 5, the profile and the mindset of investors. I might just add one or two comments before we move to the next module, the next segment. My other maybe couple of closing remarks on this area. Various combinations of investors that don't work out well. This is, I can't prove it to you mathematically, but I can tell you that if you bring in a super angel surrounded by multiple smaller angel investors, there can be a frustration level that builds. If you bring in family office, let's say, or a consortia, a group of people, and you bring in another group that's a rival to them, for example, 2 different family offices that might compete, they often don't make good collaborators with you. And so I'm not picking on family offices. Please don't take it that way. I'm just saying that there sometimes are combinations of investors that don't work harmoniously with each other. They don't work on the same, they don't sing from the same song sheet. And when that happens, you can have trouble. I've been called into discussions with actual investors who are already in a deal, who you might call factions. They're groups that have developed over the term of the investment, or they came in already perhaps competing for that deal, interested in outbidding somebody else for your wonderful deal. If you should happen to see that, that's like selling your house and having multiple offers that raise above the asking price. That's an exciting time, but it's also a challenging time, because sometimes those investors don't see eye to eye and they create friction. So again, the message to you as an entrepreneur, not just say yes to the money. That's not the only thing. Yes, of course, receive the money and be happy about that, of course. However, be careful that the mix of your investors is well thought out, so that you can understand their needs and not create for yourself additional friction and additional pressure. That's the real challenge. So I'd offer all of that as the profile and mindset of the investor. The art of being investment ready is to understand the mindset of the investor. The investor is this amorphous kind of blob of people out there, but there are some factors. There are some ways of thinking that are typical of all investors. I've tried to go over those with you in segment number 5 here, and I hope that you will have success in realizing that you will need to spend time in cultivating and understanding. My closing statement on segment number 5 is that the investment ready process of being ready is continuous. It's going to require a large percentage of your time as the CEO. You can have help from other people in your business, but generally it's got to be the founder and the leader of the business who makes these discussions points to people, makes the pitch, speaks to investors, and goes through the entire process. That's a challenge, but at the same time, it's the most rewarding part of this, because with your capacity to speak candidly and directly to investors, you will be able to attract capital, and I know that you'll be successful at that. So let's pause there. We'll come back in a few minutes and we will consider segment number 6. Thank you. Hello again, everybody. Welcome back. So just as we were leaving segment 5, it just occurred to me to mention one other approach to investing, and that's where there's a pattern these days of some angel investors doing what you call a cascade type of investment. And so here's how it works. They will take, let's say they will invest in 10 companies, making up an example here, $100,000 in each of 10 companies, $1 million invested, but they have a fund of $3 million. So they'll invest $1 million in these deals, and they will work with them. So they might be in an accelerator, in an incubator. They might just work away with you and monitor and keep going and keep understanding what's happening. 10 deals. Let's say after about 6 months, 12 months worth of work, 2 or 3 of those deals looking good, getting traction, succeeding. The other ones getting weaker, dropping out, failing. Then they will take the remaining $2 million and put it into those 2 or 3 deals. That's interesting. And that's the cascade effect. So in a certain sense, I don't want to accuse them of motivation at all, but 7 or 8 will get starved out then, and then the 2 or 3 will get geometrically, progressively much higher investment. And that's a way of preserving capital for the winners, and it's a way of picking winners more effectively than funding everybody equally. So you start out funding everybody equally, but then you realize where things are going, and then you act accordingly. So that's just a final comment on segment number 5. Moving to segment number 6 now. This is kind of like an other key factors in the investment process. I'd like to talk, some of these are more random and miscellaneous, but they're all essential to the investment readiness that you will want to exhibit in the marketplace. So here's a couple of things. One is surrounding yourself with advisors. So it's important that you understand the tax consequences of what you're doing. And so if you, let's say you're a Canadian company and you're trying to start the idea of a business in Canada with maybe sales in the US as well, well, you need to get tax advice early on, because you might start to set up a company that has operations in the US and in Canada, or both, and or you might have components of your business that are operating in both markets, but others not. For example, some people put the IP in a holding company, and that's a Canadian registered company, but the sales and marketing organization where the revenues flow and the product development, product manufacturing, or service that you're selling is in an opco, an operating company. And so what could happen is that you might create for yourself the wrong tax situation. And so it is important to get tax advice early on. Similarly, with your accounting system, I have been a proponent of setting up your accounting system so that you have a spreadsheet capacity to simulate all sorts of scenarios by product, by geographic region, by segment, and by any other factor that makes sense. And so if you have the ability to simulate all of that and can set up a good accounting system with a dashboard kind of metrics, early warning system, color-coded, yellow, green, red, all of that. We've spoken about that before. That's a factor to take into account. So is legal. You need to have the right legal advice. You need to set up your business so that you have a good unanimous shareholders agreement. You need to have simplicity of share structure, one class of shares, not 10 or not 5. Intellectual property protection. Get good advice on where you should lodge your IP, because your investor may not want you to lodge it in a separate holding company. They may want you to put it all into a single corporate structure so that they invest and participate as one of the owners of that IP. If you try to shield your IP from your investor, chances are they're not going to be as interested in doing it. Similarly with patents, we find a lot of deals are done where people spend too much money on patent protection in too many countries where there's no possible hope of your business needing that for several years. So it's a balancing act, of course, because you might want to protect yourself and have patent protection in a number of countries, especially if you're a disruptive technology. But if you're not, you might spend too much money. I could tell you many, many stories of people who have blown their capital. They may have $100,000 of initial founder capital in some kind of a product that makes a lot of sense, but they blow that on patent protection when in fact they should have spent it on sales or sales and marketing. So just saying that's that and trademark protection. These specialties are all advisors. I have proposed to various companies like law firms that they put packages together for early stage, excuse me, and startup companies, so that you can take advantage of the lower rates that they might put together in a package. So it's important that you protect your proprietary information, but at the same time, you need to be smart and wise in how you set this up so that you're not at risk, and that when you're down the road, months and years later, you're not retracing your steps. So it's important to surround yourself with a group of advisors from the very beginning. We always advise people, don't waste your time doing your thinking in front of your advisors. Do your thinking with unpaid advisors, personal advisory board that you might set up with specialists in your industry or experienced investors who can help you achieve the steps that are necessary without wasting your time. In other words, the best example I could give you is if you're going to write a unanimous shareholders agreement, check out the main bullet points of what goes into one. This is easily researchable online. And when you do that, you then go to your lawyer and then you say, okay, here are the 5 decision points we've made, A, B, C, D, E, and please pay for this. That's how you do it to protect yourself. Your presentation and discussion style is important. You need to exhibit openness and honesty and candor. You need to be, as they say, coachable. If you you need to show confidence. Yes, you need to be confident, because we, the investor, want to see that you believe in your product or your service, and that you have confidence that you're going to achieve your goals and dreams. But you may run across an investor who is more knowledgeable than you, that has more experience, maybe has colleagues that have more experience, and they want to see if you're willing to take their advice as well. The value of an angel investor is that they come with experience generally, and of course the hard news is that they may want to tell you what to do. And so your willingness to hear and be open and coachable is part of the factor here that's important, and it will help you to keep your credibility high with the investor and possibly gain confidence from them. In the due diligence process, I'd like to just go over some of the major steps of the due diligence process. If you've combined everything we've talked about in this presentation of 6 hours, you're going to see that the due diligence process opens with an initial expression of interest on your part. You may be standing in front of an angel investor group, or you may be approached by an investor yourselves. And the point is, you're going to go through an entire due diligence process where they're going to discover increasingly things about your business that will lend confidence to their thoughts about you, and they'll hopefully end up with you getting a check, or at least the next meeting, and then ultimately the check. So the due diligence process is one that you must guard carefully. It's confidential. And so and of course, you will now at some point disclose proprietary information. We've said before, in a pitch, in your investment pitch, your 12 key question pitch, don't reveal anything proprietary at this point, but ultimately you will. And so in the due diligence process, you need to create a milestone where at a certain point, you will issue or expect people to sign an NDA, a non-disclosure agreement, which gives you some protection in case that people would reveal information about your deal. The due diligence process also requires you to put a schedule together. This is always a negotiation, but it is in your best interest to keep pushing for a schedule so that at some point you get to understand yes or no, they're interested or they're not. And you will face resistance from that because the investor doesn't want to be rushed or hurried. Although the good news is that increasingly some of the investors are actually people who want to stick to a process. Family offices or consortia or professional groups of investors always want to stick to a process because they don't have time to waste either. Their interest is to see a lot of deals and screen them and then come to conclusions quickly. So that's all good news. So in the due diligence process, you will want to create a schedule. You will also want to create a milestone list. So if it's 5 or 10 different things, here's some examples of milestone steps that you would put into a process. Number one is, initial pitch. Well, actually, even before that, initial selection of target angel investors, then initial pitch, then expressions of interest, then continuing meetings, then the launching of your communications process that we spoke about, then dealing with possible tire kicking and analysis, and the deal room, which we'll speak about in a second. All of these are steps in the process. And then at some point, the issuing of a term sheet, which we'll speak about in a second here. And then ultimately negotiation, and then receiving capital, and then executing the business plan according to the money that you've received. So be in command of the process. Don't be passive. Don't simply accept the angel investors process because they may not have one. They may, which is good, but you don't know that until you've actually broached the topic and raised the idea. And so if you have a process that's respectful and that is, robust and good, but credible, then you will have helped your due diligence process work to the greatest advantage. Generally, the due diligence process works on probably a minimum of, I'd say, 3 months, all the way to about a year. If you can do a good negotiation in 3 months and receive some capital, you're good. That's at the top of the game. 1 year into it, if you're still talking with somebody, I don't think it's going to happen. And so you need to have a set of milestones in your mind, which are go, no-go decisions. You'll check a box, or you will not check that box, and you'll make a decision as to whether you stop or continue. The deal room. Let's talk about the deal room. In an older time, in a previous era, the deal room was a physical location where you had all the books and the documents, the minute book, the business plan, the technical analysis, the technology, the intellectual property, all that stuff was physically located in a room, in a place where the angel investor or the investor group could scrutinize the information, and they could have access to key staff, key individuals, key executives to review everything about the deal. Now, of course, it's not possible to do that in all cases because angel investors are not, they used to jump on a plane and, fly 2 hours and try to do deals in an area that's very close to them, a couple of hours distant, maybe maximum. Today, they're interested in seeing it all electronically online. So you need to create a secure deal room. Well, what could that look like? It could look like a website that's a privately linked or accessible website where you have lots of information available, and that you have video, and you have audio, and you have maybe print, and you have all your documents nicely arranged so that the due diligence, once they've signed the NDA and they're going through the deal room with you, they can have access to all the information. Additional queries and questions will come up, sure, but the point is to try to anticipate about 80%, 90% of all the questions that will be asked, and to have that all information accessible. That will be efficient for your process. If you do this well, you're going to have, your angel investors will come through the process. You'll be able to have more people come through your deal room quickly, and you'll spend less time. You'll waste less time as well. And if you also think about all of the information that you will have available to them, and you can anticipate that, you're going to be better off, rather than running around scrambling at the last minute to find stuff that is really basic information. That's a problem, and it occurs a lot. So if you can have a very sharp deal room, that's very important. Let's turn to the term sheet. The term sheet is a document which at some point is going to outline what your expectation is as to how much capital is going to come in, how it will be treated, whether it's going to come in as equity or debt, what mechanism, what the terms are, what it's going to be used for, and how long it will be used, and what your potential exit is, and so on. Online, you'll see all kinds of term sheet examples and module or templates, I should say. And if you use those, you will create a very good term sheet that will be well respected and well understood by your potential investor. A word or two on NDAs, non-disclosure agreements. There is a tendency for investors to resist signing an NDA. There's a tendency for entrepreneurs to push an NDA on an investor too soon in the process. So what I would recommend that you do is you would have something like this, a thought like this. You should be able to present a business plan, a pitch deck, and maybe an oral presentation, even the first meeting after your pitch of maybe an hour, where you're disclosing a little bit more information, all without an NDA. But when the NDA time comes is when you start to reveal the nature of your intellectual property, the secret sauce in your technological process, the patent, the information on how your device or your product works, or its impact in the marketplace, or market studies that you've done that are proprietary, that tell you where you should be focusing and why. Information about your budget, your margin, your costs, your actual supply chain, and all of these details. There comes a certain point when you're going to move beyond that simple slide in your pitch deck that's non-proprietary and gives information, and you're going to move now to the 100-page spreadsheet that gives all the details about your package. That's where the NDA comes in. And so you need to be careful about when you spring the NDA on people. Investors will accept at some point that there has to be an NDA signing. So the delicate balancing act is that you don't do it too soon, you don't push too hard too soon, but ultimately you do put it in place, and then you make sure that you both parties respect that. Investors don't want you to be talking about who they are to other investors or revealing their identities necessarily. Similarly, you don't want the investors looking at your information to be talking about it outside of the scope of their company. And by the way, you will have to accept that they are going to speak to their internal team about the deal, including their board. And so, and even their advisors, their accountants and their tax people. So once you agree to reveal information under the protection of an NDA, the spread of information is actually quite rapid, still within a trusted group, yes, but at the same time, you cannot expect that it's going to only stay in the mind of the one person who's the investor, perhaps the person writing the check. It's going to be to his or her advisors as well. So that's the NDA concern. The investor package, what does that really look like? The investor package is really composed of several things. One is the pitch deck, and the other is the business plan, the term sheet, and actually everything that goes into your deal room. But there's a step in between that is the initial investor package. The full investor package is revealed in the deal room. But from the pitch deck, the pitch itself, to the deal room, there's an intermediate step. And that step is what I call the investor package. And in that investor package, you should include more information, still being careful about revealing proprietary information, but putting a business plan in place, for example, putting more detailed financial information in place rather than just the summary that you showed on your slide, more detail on the product, some initial details on sales. So once again, the point of it is to not to tease the investor, but to show more information than you've revealed, but at the same time, be now ready for to spring the NDA step along the way. So the investor package is important. I would advise on 3 different slide decks. The first slide deck is going to be the one that you use to pitch to the initial group, say 12 or 15 slides. That's enough for the pitch, and that's all anybody wants to see. But for the immediate next meeting, you should have the 150 slide deck or the 120 slide deck, and that is 5 or 10 slides on each of the 12 key questions in further detail, breaking them down. And that's why I call it the 120 or the 150 slide deck. That's so important because more detail, more information, willingness to reveal that is a sign of good faith, but also it's a logical next step. You need to do that anyway. Finally, the third type of slide deck to prepare is what you would call the drill down slide deck. So it might be even more than the 150. It might be several hundred slides. An example of a drill down is, let's say it's the technology. You might have 50 or 100 slides on the technology itself, all the details, all of the drawings, all the diagrams, all of the specs, all of the information, the studies, the market research, the scientific studies, the backdrops, the white papers you may have printed and published or that you have at your disposal to prove the merits of your technology. That's all in those drill down slide decks. And so it's wise of you to prepare all of this in advance and have it ready up front. So there you have some general other factors that go into investment readiness and preparation for your investors. I'd like to turn now just for a few moments to kind of a wrap up of a few investment anecdotes and deal stories just to show you how this can actually work, both the dreaded, scary stories as well as the success ones. And so I wanted to tell you just 2 or 3 quick stories. One that came to mind is the fastest I've ever seen a deal occur was a company that pitched to our investor group about 10 years ago now. And they were making portable shelters for third world countries to use in emergency situations like earthquakes or floods or other natural disasters like that. And their investment pitch was the CEO standing in front of the room, making his introduction, and then playing a video, which was a sped up version of a assembly of this module. And so in about, I think, 3 minutes, this fast action video showed how 2 men could put this package together and build this portable housing module on site with a minimum number of tools and the usual story like that. And it was so successfully received that actually, I remember that day well, 3 people from the audience came forward and said, "Here's the check, I'm in." And they did no further due diligence. They just believed from the visual that was the right kind of product for a situation. And it had a ready market because it was aimed at a sort of a United Nations level of entity or organization. So that was a pretty cool story. I've seen slow deals. I've seen deals that would exasperate you, tear your hair out because it just goes on. I've seen deals done a year later, or even a year and several months later, against anybody's even wildest expectations, everybody in this one thing case I'm thinking about for sure figured that this would never happen and these investors would go away. But honestly, in a year and a half or so, they came back and said, yeah, we're going to ready to do a deal. And I think the background to that is that they may have had another deal that was pending or that took their priority in the interim, and that didn't go anywhere. And so then they came back and finally said, let's do this. So the poor entrepreneur was very patient and I think had some investment, yes. So kind of the deal muddled along, but they waited a long time. They lost really a year, you could say, but at the same time, they got capital and then they continued their process. And luckily, in that instance, there was nobody on, no competitor on their tail that was pushing. So it was kind of it was a bit fluky, but it was very frustrating for everybody because they're waiting for these investors to take action. And a year plus later, it was a problem. Another anecdote that I would pass on to you is the valuation problem. Once again, it's most entrepreneurs value their business too high. Technically speaking, if you have no revenue, your business is worth zero, even if you have put money into it, even if you have intellectual property protection, even if you have beta testing that's positive. All of this is all great and it's good, but technically speaking, according to the principles of valuation, if you have zero revenue, your company is worth zero. Now, most investors don't take such a hard line. They will say to you, yeah, I understand that you don't have any revenue. And of course, you've put in a year, you've put in IP, you've done sweat equity. And so, sure, we'll let you believe and we'll spot you this value. It's $500,000 or $1 million or even $3 million. Sure, your company's worth $3 million. Go for it. But when they start to put their dollars in, then they will hard negotiate. And so my cautionary note to you, my warning to you is don't be ridiculous on your valuation. And I also say the same thing to investors. Don't be ridiculous and offer somebody zero when they've in fact already spent 2 years putting money and time and all of that into it. So I give this warning to both the investor and the entrepreneur. But the entrepreneur, I say, don't overvalue because you will be ridiculed if you do. And I can tell you a story. I remember this one particular deal. It was a kind of a software learning tool thing. And it was, they came to us and we said, well, what's the valuation? Well, it's 15 million. It was some ridiculously high number. They had no sales, but they had put in a tremendous amount of work writing software, writing actual hard copy, because it was a learning thing. It was an educational type of investment. And they had put the valuation together and they came up with, $15 million. And we said, well, no, it's not going to fly. Excuse me, go away and come back with a better valuation. Here's the problem with your valuation. So we went through a little bit of a discussion and a dialogue, and they came back a week later and they said, good news, we have a better valuation. And we said, great, let's hear what the better valuation is. We're going to be evaluated at $12 million. So they went from 15 to 12. Well, you can see from that anecdote where that story is going. It was not very successful of a story to pitch to us because, incrementally dropping from 15 to 12 is not even close to what was necessary. The proper valuation for that business at that time was probably 2 million, let's say. And I'm not revealing any information about it, of course, but the point is ridiculous valuations will have most investors simply not even interested in pursuing the second meeting. And so you need to be careful about that. So those are just some quick stories about it. I have found though that, I'll tell you one other quick one. I had another time when we were talking about valuation and we found 2 investors that were interested in this deal. And so it was our custom at the time to have all of the investors interested in a second or third meeting after a pitch to come into the same room and have a discussion, and the company would be there and there would be sort of a general discussion, which would then lead to, I guess, you could say, to the third and the fourth and subsequent meetings. And what happened was we had two groups of people come into the room and sit down, and the company was sitting there as well, and I was there with my team, and all of a sudden one of the investors across the table raises his hand and says, "Excuse me, we are not comfortable sitting in the same room with so-and-so across the table." And so-and-so across the table said, "Actually, right, when you think about it, I'm not very comfortable talking about this in front of the other people as well." It was an embarrassing moment because we hadn't anticipated this. We didn't expect that there would be this level of animosity. We didn't actually know that. And so I suppose you could say I'm not trying to take blame for it. I probably should have anticipated it, but I didn't. And we were trying to be efficient in our process and have this sort of follow-up meeting to the pitch with all interested investors in a spirit of collaboration, right? No proprietary information needed yet to be shared, but there we were. And so we were at a stalemate in that meeting. The meeting had to end because neither party wanted to sit in the meeting. Now, in the end, neither did the deal, but the sad part was that they were not even seeing eye to eye. And so we cautioned the entrepreneur. We said, look, already that's a sign. Like, if they're both going to be interested in your deal, don't do it, because you're going to have this kind of a stalemate at every step of the way. But strange things happen in some of these pitch presentations. And so investment readiness is about really doing your homework and understanding the mind of the investor. Just as much the investor tries to understand the mind of the entrepreneur. In most cases, I will say this, the investor is probably better educated on what goes on in the entrepreneurial mind because they see hundreds of deals. They have experience seeing a lot of deals. Whereas the typical entrepreneur may have raised capital, may not have raised capital, but is still only going to see maybe several dozen investors. They're not going to see hundreds and hundreds and hundreds of investors because no one has that kind of time and no one has that kind of access to investment. And so I think in general, the equation is balanced. It's balanced in the sense of negotiations between the parties. Yes, more or less it's balanced, but the experience level is tipped more in the favor of the investor these days because they see a lot more deals. That's just the nature of the game. And the entrepreneur is not likely to see investors in the same way. And so the solution to that is for the entrepreneur to see more deals, and that's, or to see more investors. That is the important thing. So anyway, that's a few little stories. I'd like to summarize then now with the key lessons learned in my years of being an angel investor and in running an angel investor group for 12 years. So first of all, the key lessons are that the length of negotiations should be anywhere from 1 or 2 months to about a year. If you're still in discussions with an investor after a year, and you may be investment ready, but I doubt if they are. And so that's a key lesson learned. Secondly, the focus of the entrepreneur on the entire process, the entire investment package, the deal room, all this preparatory work, the 12 key question slide deck, the 150 deck, the multi-hundreds, the drill down deck, all this preparation, it's wise to have it all ready ahead of time. If you're running a process and you're still scrambling to put content together, there's a challenge there. And so the lesson is focus ahead of time, take the time to, even though you have competitors on your tail, yes, understood, but take the time to do the prep properly, because once you have done that, then you can focus entirely on the process of negotiation and securing capital and building the confidence on the part of the investor, rather than running around trying to put content together. It's a mixed message. The third lesson learned is the CEO needs to be the leader, the founder, the main person for whom the accountability is the highest. They need to be leading this search for investment. They need to be the one making the pitch. They need to be the one talking to investors. They need to be the one running the deal room and answering questions and being visible in the process. You cannot be invisible if you're the leader, the founder, the CEO of the business, you must be visible. Therefore, the art of delegation. You have to have a team then that can run your company, your development, continue this process of sales, product development, et cetera, while you, the CEO, are out hunting for capital. And if you are the CEO and you cannot spend half of your time, 50% of your time on the capital process, it will not work well. You can take your CFO type, your finance person, or your chief technology person, whatever. You can take some people with you, and you will include them increasingly in the process as you go through the due diligence process. But you will have to take the leadership yourself. And once you start the process of capital, while you're doing the first round, you already must be looking at the next round and the subsequent round after that of capital. And so it's a multi-year process that will take a significant amount of your time. And until you have finished raising all the capital that you need, you're going to have a challenge there if you don't spend half of your time or more, and if you don't have help to run the rest of the show while you're doing that. Lesson number 4 that I would position in front of you is the openness and truth part. You need to tell the truth at all times. You need to not minimize the challenges or difficulties. You need to be open, transparent. You need to show information under protection, like an NDA, yes, but you need to be somebody who is very open, approachable, coachable, as they say, and you need to do that on a regular basis all throughout the entire process, because the test ultimately of angel investment is, do we trust and believe and respect that CEO, that leader, and the team? Both are important, but until that foundational leader is clearly given respect and is respected, they will not make the investment decision. The other valuation, another point, is valuation is always a negotiation, even though there's some science to it. We've spoken about that in this workshop, about some of the methods of valuation, but it's always a negotiation. And so you need to show flexibility, and you need to bring a range of valuations with you, and at least agree on the methodology of valuation. That's the thing. If you can do that, then you're ahead of the game and your process will be very successful. And then I guess finally, the whole process of raising capital is one of building trust in your business. It's one of showing that you intend to respect the investor's dollar and make them successful and wealthy in the end, and that you're going to do everything in your power to respond. Because of the belief in the team is so high in the mind of the investor compared to the business plan or the technology or even the market, even if it's rapidly growing and even if it's a big market, you've got a problem unless you can show the resiliency of the team in terms of changing on a dime. It's pivoting, rapidly when the world changes on you. And so those are the key lessons that I've learned over the years. So if you have any questions then for me, please email me or phone me. And Cast has my information. I have also contacted all of you as well. And so I'm looking forward to speaking with you. I'm happy to talk with you even further about this topic. So I'd like to just end by summarizing then what we've covered in these 6 one-hour modules. We first talked about the process of negotiating capital, and we talked about the mechanisms, the financial instruments, communications, the different rounds, how to do the plus delta, and so on. Secondly, in the second hour, we talked about the life cycle of the business. There's a lot of different businesses ranging from I guess you'd call it the growth business, the rapid response business, the lifestyle business, all of these different types of life cycles. Very important that you match that with that of the investor. Third, we talked about deal structure, cap tables, minute books, USAs, that sort of elements, different kinds of shares, different mechanisms of equity and debt. Fourth, we talked about valuation. We spent a lot of time talking about the secrets of how the valuation process works, both technically, the science part, and then in sort of objective negotiating, which is the art part. So valuation is an art and a science. And then finally, we talked today about the profile and the mindset and the different kinds of investors. And then we concluded with due diligence and topics like the NDA and preparing the investor package and the various slide decks. And then I told a few stories about some of the more interesting deals that have been done in the past. So I'd like to encourage you to continue to develop your businesses. It's been great working with you on this workshop and this webinar. The Are You Investment Ready topic is very important. It's still, in my mind, preparatory to the 12 key question format. If you'd like to sign up for that, I would be happy to. And you could phone me or email me, and I can discuss with you in advance what will occur in that 10-hour package. You will end up with a 12 key question pitch deck that is the most exciting possible pitch deck for your business, because it will take into account not only all of the answers to the 12 questions that are typical of what goes on inside the mind of an investor, but it will answer them in the right sequence, and it'll unfold that information in a way. And we will practice with you on delivery of your pitch. And in the end, you'll end up with a high quality pitch deck after that workshop. And that pitch deck is going to be then useful for you to raise capital and to do other things too, like sell your product or introduce new marketplace and new product ideas to the right audience, as well as in pitching your deal for investment, certainly, but in addition to that, being able to brief your bankers, your investors, your shareholders, your stakeholders, and anybody else that's interested, including your governing board and your advisory boards, on the state of your business. So the pitch deck is a key tool. It has to be done well. At the end of that workshop, you're going to have a really good quality pitch deck, and you will have rehearsed it, and you will have received commentary and input from not only from me, but from other investors as well. So thank you very much for participating in these sessions, and good luck with the investment process. And I'm happy that you participated in this session, and I wish you all the best. Thank you very much.